Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Let's talk about the yield curve. So we're seeing the yield curve basically get into inverted territory all over again after steepening a couple of days, a month or two back, or in last year. Now last year we did see the low around minus 0.85%. Right now, we're very close to that level. We're sitting around minus 0.82%. So what is this yield curve telling us? Well, the yield curve is basically telling us that if the growth data continues to be strong, like we saw with the jobs number, the non-farm payrolls number, the employment numbers, the JOLTS number, and any other jobs number that is coming out, or employment-related numbers coming out, or some growth numbers coming out, if that continues to be strong, then the Fed can hold rates either high for some time or even continue to raise it to levels where the markets are not expecting, like maybe 6% or close to it. I did a video on 6% interest rates. Take a look at that. I did a video on that yesterday. Now, this inversion in the bond market is telling you that, hey, if we continue getting this narrative and continue for the markets to agree with this narrative that, yeah, we are getting a soft landing, we are getting strong growth, we are seeing that all the money printing that we did during COVID pandemic is still playing into the effects of that, still playing into this year, which is causing the high spending, which is causing people to still be resilient and high spending in certain areas for certain subgroup of people, obviously lower than what it was before, but still that higher inflation numbers, those wages that, yeah, they're somewhat coming down, but if you hear news like, for example, Walmart increasing their minimum wage, it's still showing resilience. The growth numbers are still showing resilience in the economy, in the markets, which basically suggests to you that, hey, if this continues to be the trend, the bond market will continue to maybe invert, which might signal to you that maybe this is a deeper recession than expected, especially down the road, right? So it's looking like that may happen, where we're pushing out this real recession that we're expected to see, just because as the growth continues to be strong, and as yields continue to move up or rates continue to move up, inflation is coming down when you look at the CPI number, but not to that 2% target yet. And still there's lots to take into consideration before you call victory on the 2% inflation. Now, before we get to that 2% inflation, a couple of things needs to happen. We need to see the growth data start to deteriorate, like the Fed has been talking about. We need to see the jobs numbers start to also become weaker and weaker, the unemployment rates start to move up higher, but we're not seeing that. And if we're not seeing that, that basically is telling the markets, especially the bond market that's inverting here, is telling them that, hey, maybe something more needs to be done in terms of interest rates. And when Bullard came out to talk about the Taylor rule, getting rates above inflation, may look like that may be a possibility, and it may come true down the road, maybe this year. And then maybe the true effects or the recession starts maybe in summer or December of this year, or sometime in 2024. And this delayed effect is just because we see the strength of growth, the resilience in the equity markets, and most importantly, the effects of all the money printing that was done during COVID time. We're still seeing that since we printed so much money, maybe perhaps that is also playing into effect, which is creating this resilient market. There's probably some people that still have a lot of cash saved up. And I'm not saying everybody, maybe a certain subsector group of people who are going out and spending in certain areas. So it'll be interesting to see how this plays out. It'll be very interesting to see, especially if the yield curve inverts and makes a new low this year, which looks like it's heading towards. And it'll be interesting to see how the long end and the short end bonds also play. We have seen, selling in the long end and short end bonds. We also saw today the equity market selling off. And when you get bonds and stocks selling off, that does signal to you that there's fears. Looks like there's fears on this interest rates and for the upcoming inflation. So it'll be interesting to see how the upcoming inflation CPI report looks like, how the upcoming data looks like, and maybe we might get a relief rally if we get the CPI to come in weaker than expected, and then maybe that steepening in the yield curve to come in after maybe making a new low. So let me know what you guys think. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.